When silver crosses a level, the world mentally labels impossible. It stops trading like a metal and starts acting like a warning light. On December 23rd, spot silver hit $70 an ounce for the first time. And within the next breath of the market, headlines were already printing 71, 72. Like the number itself had lost meaning. And here's the part that should make you sit up. This move is not being driven by one cute story. It's being driven by a pile-up industrial demand, investment demand, inventory stress, geopolitical friction, and rate cut expectations hitting the same narrow doorway at the same time. Now, why is Elon Musk in the title? Because Elon didn't cause the silver crisis the way people online imply, like he pressed a button and the world ran out of bars. No, Elon's role is more dangerous than that. He normalized the next wave of electrification architecture, an upgrade that forces the supply chain to use better materials, tighter tolerances, and more high-performance contacts. And silver is the metal that quietly sits inside that entire upgrade. This is the story of how silver became the bottleneck metal, and how one industrial philosophy, Tesla's philosophy, helped light the fuse. Why Elon Musk just triggered a global silver crisis, and where silver goes next. Silver isn't just a precious metal anymore. Most people still talk about silver like it's gold's chaotic little cousin, a shiny thing, a safe haven, a coin that's outdated. Silver is increasingly a critical industrial input used across electrical and electronics applications and in photovoltaics. And unlike copper, silver doesn't get to be mass produced because demand is rising. A huge portion of silver supply is produced as a byproduct of mining other metals, meaning supply doesn't respond quickly to price. So when demand accelerates, suddenly, when the world ramps solar, EVs, grid upgrades, data centers, silver can't just spin up new production on command. And that's the first ingredient of a real crisis. Inelastic supply meets structural demand. What just happened this week? The news that matters. Let's anchor this in what the market just did. Reuters reported silver surging to record highs, pushing through $70, driven by robust industrial and investment demand, shrinking inventories, geopolitical tension, and expectations of additional US rate cuts. And Reuters also framed this as a perfect storm earlier in the run. Supply deficits plus industrial demand from solar, EVs, and even AI-linked infrastructure. Reuters. So the latest is not just price. The latest is the market revealing a new truth. Silver is trading like the world is starting to fear availability, not valuation. That's the difference between a normal bull market and a squeeze-flavored panic. The deficit isn't a rumor, it's a multi-year condition. Now we need to talk about the foundation under this move. The Silver Institute forecast that the silver market would post another significant deficit in 2025, its fifth consecutive year, driven primarily by record-level industrial demand. The Silver Institute. That matters because a 1-year deficit is a headline. A 5-year deficit is a structural problem. It means you aren't just running low once. It means you're living off buffers. And when you live off buffers long enough, eventually the buffer becomes the story. But London has silver, right? The inventory illusion. Here's where people get tricked. They'll pull up a vault number and say, see, there's plenty of silver. For example, LBMA's London Vault data shows that as of end November 2025, London vaults held over 27,000 tons of silver. But here's the problem. Vault totals are not the same as available float. A lot of metal is spoken for, allocated, earmarked, tied to ETFs, locked into long-term positions, pledged against financing. So the real question is not, does silver exist? The real question is, how much silver is movable, deliverable, and for sale at the moment a big buyer needs it? And when that movable supply gets tight, you see it show up somewhere else. In the cost to borrow metal, in lease rates, in premiums, in delivery delays. That's why, during the tightest moments this year, silver lease rates spiked dramatically before easing. Bloomberg reported lease rates surging to an all-time peak in October. Translation: even if silver exists, in theory, the market can still behave like it's scarce in practice. India. When physical starts screaming, now let's go to the most revealing place on Earth for silver stress, India. Reuters reported India faced a significant silver shortage during the festive season, with silver trading at a premium of up to about 10% over global prices, driven by surging demand, a global deficit, industrial needs, constrained supply, and rising lease rates. That's not paper speculation. That's physical reality. And when premiums jump like that, it's telling you something brutal. Price is no longer the only rationing mechanism. Access becomes the rationing mechanism. China, inventories dropping, metal moving. Then there's China, another pressure node. Reuters reported that silver inventories linked to the Shanghai Futures Exchange saw major outflows and fell sharply in October, highlighting how fast exchange visible supply can tighten. And Reuters also reported that large flows of silver from the US and China helped ease a London spot market squeeze earlier in the year, meaning the market has already been playing musical chairs with physical metal. In plain English, silver has been getting pulled, shifted, air freighted, and rerouted because where the metal sits matters when the system is tight. Now, hold that thought, because this is where Elon Musk walks into the story. Elon's trigger wasn't a tweet. It was an architecture shift. People misunderstand trigger. They think trigger means one event caused everything. No. In supply chains, a trigger is often a standard, a design choice that becomes a template, a platform decision that ripples outward until suppliers retool, competitors copy, and the entire ecosystem upgrades. Tesla has been pushing the move from 12-volt low voltage systems to 48-volt architecture, positioning 48 volts as the next standard. And Tesla's Cybertruck documentation makes something else very clear. With 48 volts, the low voltage system is treated as always energized and higher risk arcing, injury, component damage if handled improperly. That warning isn't just about safety, it's about tolerances. It's Tesla admitting, in plain language, this is a higher stress electrical ecosystem. And when you build a higher stress electrical ecosystem, you don't get to use sloppy materials. You need better contacts, better connectors, better plating, better reliability. And silver is one of the key metals used to coat electrical contacts because of its conductivity and durability. So here's the logic chain. Tesla pushes 48-volt low voltage architecture. 48-volt systems demand more robust connectors and tighter design discipline. High-performance connectors and contacts lean on silver usage across electrical applications. If Tesla's approach becomes industry standard, demand doesn't just rise, it hardens. And that is what I mean by trigger. Elon didn't create the deficit, but Tesla's design philosophy accelerates a world where silver is not optional. Okay, but is Tesla really big enough to move silver? Here's the honest answer. Tesla alone isn't the whole story. The copycats are the story. When Tesla normalizes a platform change, suppliers start building around it. Other automakers face pressure to match cost, weight, efficiency. And the 48-volt move is already being discussed as an industry shift, with Tesla openly encouraging adoption. And once suppliers scale a new standard, you get more electrification per vehicle, more electronics per platform, more demand density. Now combine that with the broader wave Reuters already flagged. Industrial demand from solar, EVs, and AI infrastructure rising into the same period as supply constraints. That's not one company moving a commodity. That's a system shift, the real engine. Solar, the silver eater. If EVs are the headline, solar is the silent vacuum cleaner. Silver paste is heavily used in photovoltaics, and the solar sector has become a major driver of silver demand. The Silver Institute has documented silver's growing use in photovoltaic applications, and PV demand has reached new highs in recent years as solar deployment accelerated. USGS notes silver's domestic use includes photovoltaics and electronics, meaning the industrial metal identity is not a talking point. It's the official breakdown of where silver goes. So when solar capacity ramps globally, especially with aggressive buildouts, silver demand doesn't politely rise. It surges. And here's the trap. Yes, there is thrifting. Manufacturers work to reduce silver per panel over time. But demand growth can still outrun thrifting when deployment accelerates hard enough. That's why so many market outlooks keep coming back to the same line. Industrial demand is the driver, and deficits are persisting. The market is telling you where the weak spot is. When something is truly abundant, the market is calm. Borrowing costs don't spike. Premiums don't blow out. Inventories don't get yanked around the globe to patch holes. But this year, we've seen repeated episodes of physical tightness. Reuters documented festival season shortages and premium spikes in India. Reuters documented visible inventory drops and flows affecting spot tightness. And multiple reports highlighted how lease rates surged during acute stress. So the price move in late December isn't random. It's the market catching up to the physical story, where silver is going next. Scenarios, not fantasy. Now the question you actually came for, where does silver go from here? First, accept the nature of the asset. Silver is volatile. It exaggerates moves. It can spike, then snap back, then spike again. Reuters quoted analysts talking about silver targets like 75 and even 80 over the next 6 to 12 months in this kind of environment. So here are 3 clean scenarios. Scenario A, the controlled melt up. Silver holds elevated levels, chops violently, but trends higher as industrial demand stays strong and investment flows continue. In this scenario, pullbacks happen, but they're shallow and bought quickly because the market is no longer confident that dips guarantee easy physical sourcing. Scenario B, the year-end air pocket. We get profit taking, thinner liquidity, and a fast drop that scares everyone out, followed by a rebound when physical premiums and borrowing costs refuse to relax. Reuters warned about potential profit taking as year-end trading volumes thin out, so this is not crazy. Scenario C, the availability shock. This is the scenario nobody wants to say out loud. It's when you get a sudden demand impulse, big ETF inflows, a procurement panic, a geopolitical snag, an export restriction, a manufacturing surge, and the physical market can't respond smoothly. In this world, price becomes less about valuation and more about rationing. And rationing has a nasty habit. It overshoots. I'm not promising a number. I'm not selling you a fantasy. I'm telling you the mechanism. When availability becomes conditional, price behaves like a weapon. Why the Musk angle matters, even if Tesla sales fluctuate. Here's the deeper point. Even if Tesla's unit sales wobble, Elon's influence is not just Tesla selling cars. It's Tesla redefining systems that other engineers copy. It's Tesla pushing architecture changes like 48-volt low voltage that make the entire ecosystem more electrically dense and quality constrained. So the Musk trigger is cultural and industrial. He accelerates the electrified future. And the electrified future eats silver, the simple question that ends this whole video. Let me end with the only question that matters. Do you think this is a normal bull market? Or do you think we're watching silver transition into a strategic material that gets rationed by access, not price?